John, if you might just get that back door there.
Oh, yeah, absolutely.
Well, your time this morning, this is an event we host for clients and friends, and allows us an opportunity to show off what we do on a weekly basis, because we work hard to find ideas, and if we can share those with our client base, then it makes us a little bit sharper and helps us sometimes fine-tune those investment theses, and we learn from our clients, and the network effect is a really valuable part of our process. A quick slide on who we are and what we do. We're a registered advisory firm with the state of Kansas. We manage portfolios for individuals and corporations and a few other advisory firms. Pretty much any vehicle that you can put a stock or a bond inside of, we can manage on behalf of our clients, and we tailor those portfolios to meet individual risk tolerances, and we market ourselves based on better research, which we'll try to put a little bit of that on display for you here today. That better research is evidenced by a really nice write-up we got last year in the Kansas City Business Journal after we were awarded a 4-star rating from Morningstar, so that's a big feather in our cap. We practice golden rule investing, which is just another way of saying that we're fully invested alongside of our clients. That doesn't sound like a big differentiator, but most advisory firms can't say that, so I'm always sure to point it out. We practice a biblically responsible investing approach, and we are a certified Catholic practitioner, which doesn't make us the moral authority on anything, but it's our effort to bring a greater sense of integrity into what we do and align what we practice on Sundays with what we do during the rest of the week. And then we look to do business with like-minded investors, and all that means is that we try to find those people we can sit down with and have a real conversation about our world view. And when those two things are in alignment, then we have the beginnings of a relationship that can lead to real trust. So I share this slide with our clients and friends every month. This shows total debt outstanding, and total debt outstanding on a global basis influences what we do more than any other one single factor. And this just shows debt in the United States across all sectors, household, government, corporate, exceeding $50 trillion currently, and when you add entitlements onto this, we're up over 100 trillion. So those numbers are too big for us to wrap our head around. So we have this chart, which shows total government expenses as a percentage of GDP. When government expenses as a percentage of GDP reach 100%, we are a socialist country. So we call this the path to socialism. This simply extrapolates what happens as we continue to spend $3 for every $2 we take in tax revenues. This won't happen, it can't happen, but some very challenging political decisions have to be made in order to correct the matter. We can raise taxes, we can lower benefits, or we can stealthily print more dollars so that we can pay down some of these debts with currency units of lesser and lesser value. And especially during this political season, that third lever seems like it's the most attractive to politicians, and one we increasingly feel like will be a part and a growing part of the solution. So based on that belief, we have a certain strategy whereby we position our portfolio to do better in an inflationary type environment. And that includes holding some gold and silver and other commodities-linked investments, as well as companies that sell products that consumers can't do without, like food and medicine and utilities and dividend-paying stocks. And one that we'll profile here today is one that we believe is fairly independent from the global business cycle and one positioned to profit regardless of economic environment. So this is a new chart, and one that I stuck in this month to brag a little bit about our client base. One of our clients sent this chart, and it's really just a restatement of the one that I showed a couple of minutes ago, but I put it in to illustrate the point that we have great clients, and they're involved, and they want to share this information with us, and we have been able to develop a natural Q&A that is really a very integral part to building that trust and relationship that we try to foster with everybody we do business with. Here's a price chart of the S&P 500 between 1980 and 2000. And it shows a great run-up in the markets as we were accruing a substantial portion of that debt that we currently owe. And that is like putting the market on steroids. Since then, in the last 10 years, we've experienced something much more volatile, and this is a market we expect to continue. You've heard this referred to as a muddle-through market, a new normal, a range-bound market, and ultimately this will be a stock picker's market that should allow firms like Cush Capital that pride themselves on research to prosper. So part of what we do on a daily basis and weekly basis is to cull sources from around the internet and newsletters and client events like this one and investors clubs. And when we see something that is particularly meaningful, I try to grab it and share it with our clients on a monthly basis. So this is a new slide that shows the unfunded portion of government liabilities and debt alongside with the publicly stated number in green. So the U.S. on the left-hand side of this chart is that our debt levels are at 98% of GDP today. So that number is high, and it's alarmingly high. But 98% by historical standards doesn't put us in the default zone, so to speak. When you throw unfunded liabilities, Medicare, Social Security, Medicaid, on top of that, we're at 522% of GDP. And by any measure, that puts us at risk of default. And third in line behind France and Greece when we include unfunded liabilities in that ratio. Again, the purpose of this chart is just to support that point that I made when I started this little presentation, that debt, more so than anything else, affects what we do and how we position our portfolios. Another new chart that we found, by the way, I need to give credit to John Malden for both of these charts that we share this month. They're in one of his most recent newsletters. He's one of our favorite newsletter writers. He does an excellent job, and he writes a free newsletter on a weekly basis that I would recommend it to anyone. This chart shows debt levels across different segments of the economy. So you have government debt, you have household debt, and you have debt at the corporate level. And anything in excess of 100% debt to GDP at the household level, that would be debt to income. At the corporate level, that would be debt to revenues. So anything greater than 100% here is in red, 70 to 100% is yellow or cautionary, and then green would be less than 70%. The United States on the left-hand side of the page there is yellow all the way down. About halfway through, you see Portugal there in red, government, corporate, and household debt. And the point of this slide is to illustrate how limited our options are when tackling this debt problem that we have. If our households are well off, then we can tax our households. If our corporations are well off, then we can tax our corporations to fix a problem at the government level. But we've accrued this debt across all levels of our society, and the austerity measures that will need to be implemented will be painful, and they'll have big effects on the markets. So last month we devoted our entire session to the euro and these issues in particular. So if you're interested in hearing more of our thoughts about that, then I would encourage you to look at the video that we posted to the web. What we typically do, last month was atypical, this month is a little more typical in that we'll share a few new thoughts on the market, and then we'll do a deeper dive into one of the companies that we currently hold in our portfolio. And this month that's on Hilltop Holdings, which we call the 75-cent dollar. A quick slide on our research process. We size everything up according to the 3 M's, which is management, moat, and mispricing. All of our investment opportunities have to have all 3 of these to get us interested. And increasingly that first one, management team, pairing our capital with other people of high integrity, takes on a growing weight inside of our process. I think of Warren Buffett's quote when he said the first rule of investing is don't lose money, and the second rule of investing is don't forget rule number 1. Well, with that in mind, the importance of a management team and the integrity of a management team is paramount. Then we also need a moat, and then the mispricing is crucial. You can have the most well-run company in the world with the best management team, but if you overpay for it, you won't do anything but damage to your portfolio. So, quick overview on Hilltop Holdings. This company was formerly known as Affordable Residential Communities. They manufactured mobile homes. They sold that business in 2007 for $1.8 billion and changed their name to Hilltop Holdings. In the process, they held on to a very small property and casualty firm. That business contributes about 20 cents worth of profitability in any given year towards the bottom line, and is a negligible part of the business and the investment case that we've built around Hilltop Holdings. So we think of Hilltop now as a big pile of cash. They have nearly $600 million worth of cash on their books. They have a great management team, and the best part about this story is that you can literally buy this company for less than the value of their cash. The management team is headed by Gerald Ford, not our 38th president, Gerald H. Ford, but Gerald R. Ford rather, but this is Gerald J. Ford, the banker. Gerald J. Ford is one of the most prolific investors in the financial services space. He has over a 30-year history of buying and selling and flipping banks and thrifts, usually in distress, at enormous profits. He's done this with more than 40 financial institutions. He made $1 billion in the S&L crisis of the 80s and 90s, and most recently sold Golden State Bank Corp to Citigroup for $5.8 billion in 2002. And in another data point that shows just how astute Gerald Ford is, he subsequently sold out of Citigroup at prices in the mid-40s. So, and now he's getting ready to do it all again with this Hilltop Holdings, which effectively serves as a holding company for Gerald J. Ford to deploy cash in a distressed banking environment. He owns 27% of Hilltop Holdings, so his interests are aligned with ours, which is another thing that we look for in all of the stocks we invest in. And he paid between $9.50 and $12.50 for the bulk of his stake in Hilltop. Hilltop trades at about 8.5 today, so we have an opportunity to buy into a business for less than what he paid. And those are significant indications of what the true underlying value of this company might be. Moat, I mentioned moat. The moat for a big pile of cash is small. Normally we look for something about the economics and fundamentals of the underlying opportunity that will allow this business and this management team to hold their competition at bay for a period of years so that they can sustain their margins and compound that capital over time. Hilltop Holdings doesn't have a strong moat, but they do have a small moat in that they're very cheap, they have a great management team, and they have a shelf charter from the FDIC, which is a license for Hilltop to buy distressed assets directly from the government. And they don't just pass those out to anybody. So there is a charter there that gives them, that creates some barriers to entry and a small moat. The mispricing is probably the best part about this story currently. When we try to figure out what this company is worth, we first start by looking at the assets that they hold on their balance sheet. And the net tangible book value of this company is $10.73. So you take all the assets that they own, you subtract off anything that's intangible like goodwill, and then you subtract out all of the debt that they owe their creditors, and what you're left over with is $10.73 per share worth of real tangible assets. The best part about that is $10.34 of those assets is cash. There's no question about that value whatsoever. Now, the hard part about valuing banks and other real estate firms, especially in this market, is, what is somebody's house worth? Well, it's only worth what somebody else is willing to pay, and sometimes that can be very subjective and makes our job very difficult. In this case, there's no question about what the cash is worth. The current price of the company is $8.34. That's nearly a 25% discount to cash, and that creates that 75-cent dollar, which is Hilltop Holdings. So you can literally today, buy $1's worth of assets for 75 cents and pair your capital with one of the best capital allocators in the banking industry of the last 30, 40 years. Another data point that supports the valuation of this company today is a $100 million stock buyback that the company announced in November. So the Hilltop's strategy is to take this cash pile and deploy it out in the marketplace. They're going to go out and they're going to buy banking assets. They're going to find undervalued banking assets. They're going to restructure those assets, make them profitable, subsequently sell them for a large profit. That's the plan. In November, they recognized that their own stock had gotten so cheap that now they can buy their own company back and create more value for their shareholders than they could if they stuck to their original strategy. So in our minds, this is a data point that supports or helps to create a floor for a stock like Hilltop Holdings. And then we have the potential for this little stock to rise significantly beyond their book value as the capital is actually deployed. So I was, before we started here, I was sharing some of this information with Mike because we put these slides together last night, and we got to this slide, and my partner Mike said that. So I think the next question they're going to ask is, well, why is it so cheap? And so we have a slide that tries to address that question. The short answer is we're dealing with a small, misunderstood, and underfollowed stock here that has been miscategorized by most of the research companies. Standard & Poor's is one. If you go to Fidelity's website, you'll get research reports by Ford Research, Activo, a handful of others. All of these companies categorize Hilltop as an insurance firm. And remember, that's a negligible part of their business. The core part of their business is this pile of cash that has yet to be deployed. But there really are no peer group comparables for a big pile of cash. So the research firms categorize Hilltop Holdings as an insurer. And inside that universe, Hilltop Holdings is mediocre at best. So there's a misperception out there in the marketplace that helps support the reason for why this stock is so cheap. But the key most reason why it's so cheap is investor frustration. Hilltop Holdings has been sitting on this pile of cash since 2007. And on a quarterly basis, they have reiterated their strategy and their intent to deploy this cash. And periodically, they'll talk about a deal that they bid on or one that just didn't come to fruition for one reason or another. And investors have begun to grow a little bit frustrated over that time horizon, waiting for this company to put this cash to work. So I think it's only natural for an investor to question or raise the question, why am I paying this management team to basically do nothing? And that's a reasonable question, and we understand that very, very well. And it supports and answers the question, why is this stock so cheap? We view that question asked by most other investors as a hallmark or an indicator of what could be an extremely good opportunity, because we recognize that what's going to make us successful as value investors over the long term is a greater patience and willingness to wait for only those best opportunities. And that's exactly what Hilltop's management team is doing here by being so slow and so deliberate to deploy their cash. And in what should serve as a catalyst to force the market's hand in recognizing the true underlying value of Hilltop Holdings is the first deal that they've done in the last 3 years inside of the banking space, which was July 29th of 2011. They did a deal with SWS Group. This is a bank and broker-dealer firm based in Dallas. Hilltop Holdings is also based in Dallas. The two firms are literally right down the street from one another. So to speculate that Gerald Ford, given his track record, knows very well this management team, this bank, the assets and loans that they've made, and what the underlying assets are worth, we feel like is a very safe bet. As a part of the deal, Hilltop Holdings extended SWS a $50 million, 5-year, senior unsecured loan that pays them 8% on their money. Not too bad. In the deal, they received 8.7 million warrants with an exercise price of $5.75. Gerald Ford gets a seat on the board of directors, non-voting, and since July 29th, they have added to their ownership stake by purchasing 1.1 million additional shares at prices under $5.50. The total capital commitment of this deal, assuming the warrants are exercised, is $105 million, which is 20% of Hilltop's current market cap. So this is a sizable deal for them, and it's a deal that we feel should force the market to recognize the strategy embedded in Hilltop's, this vehicle that has been created to acquire banking assets. And the deal is already a good one and should serve as a catalyst to move the stock. There's the last point on that slide, and that's evidenced by this stock chart, which is not, this is not Hilltop, this is SWS Group. This is the stock chart of the bank that they bought into on July 29th. So this shows what has happened to that share price since July 29th. You can see there on the far left-hand side of the slide, the company was priced at about $6 when the deal closed. So the warrants, which were for $5.75, weren't worth anything at that time. But since then, those warrants have appreciated in value, or now in the money. SWS closed yesterday at $7.01, which amounts to greater than a 20% appreciation in just 5 months on the capital that they've deployed already. And very opportunistically, Hilltop and Gerald J. Ford creeped back into the market there in August and early September when the stock dipped below $4.50 and bought another 1.1 million shares. So this is evidence of exactly the type of deal that we've been waiting for, and validation of a management team that we thought was astute and now has seemingly proven themselves out to be. So a few other points on Hilltop Holdings. They still have a lot of cash to deploy. We feel like there should be and ought to be more opportunities for them to do that as banks continue to fail at an alarming rate. Foreclosures are expected to rise in 2012 on the heels of a voluntary lift of the foreclosure freeze. This is in the wake of the robo-signing calamity. So all of those data points should create more opportunity for a company like Hilltop Holdings. This little chart shows, the blue bar shows number of banks that have failed in each year, and then the green dots on the chart, which might be a little bit hard to see, show the dollars worth of assets that have failed in each year. So it's significantly declining, but we feel like there should be plenty of opportunity there for a savvy management team like Hilltop to deploy some more cash. And that in a nutshell is Hilltop Holdings. You have the opportunity to buy cash for less than the value of $1. You have a great management team, and you have a deal that's been done in the last 5 months that is just now starting to have a meaningful impact on the business, and as of yet is unrecognized by the marketplace. Pair that with a $100 million buyback campaign, and we feel like you have the makings of an investment that should do very well on inside of our client portfolios. So what we typically do is just turn the floor over to a little Q&A. We encourage anybody that comes to do a little bit of networking. We like it when our clients and friends can do some business together. So if you'd like to introduce yourself and say a word about how you got here, that'd be just fine. We'd welcome that. I always try to point out that we host an investors club, which we call the Above Average Odds Investing Club. This is not a part of Cush Capital. This is just an investing club that we host. But if anybody has an interest in some of the due diligence that we put into this type of research and wants to get more involved, then let me know and I can get you involved in that. So, Mike, did I miss anything?